the attraction and the ability to deliver a 50x or 100x has always been very attractive, because that's what defines not only fund success but individual success. People say, "Oh, I invested in this company and it went 100x." So
Right. Legendary investor in
yes,
Google, legendary
yeah,
investor in
for a
Facebook
5x,
or-
nobody
yeah,
will call
correct.
you legendary, right?
Right. This is my conversation with Kanwal Singh, founder of Fireside Ventures and the first venture capitalist I've ever had on First Principles. I held off on VCs for years because this show is about the people who build. Kanwal is the worthy exception. At the top of the tech investing boom, he walked away to start a fund for one thing almost no one believed in back then: Indian consumer brands. Part 1 is that bet, what investors actually said when he pitched it, why his first backers were consumer families rather than institutions, the fund design he kept correcting, and his working map of the three Indias he invests behind. Part 2 is where we get to the man and the career that transformed him. For now, here's part 1. Kamal, it's so good to finally have you here. You and I have known each other for actually nearly 20 years.
Yeah, I know.
And since 2006, when I was much younger. But you were already a venture capitalist. You were a co-founder at Helion. So this is actually a slightly unusual conversation for me in the best possible way. You're also the first venture capitalist I've had as a guest on First Principles. I've largely held off on having investors on the show because the conversation tends to drift to their portfolio companies.
Sure.
That's what venture capitalists like to do rather than to the investor themselves. With you, I decided to make an exception because what interested me wasn't just the brands that you've backed, but it's the bet that you've made with Fireside Ventures itself. Now, you walked away from tech investing at the peak in many ways, many senses of the tech boom to start a single category consumer fund at a time when almost no one, I remember that. I mean, I can say this with confidence because I was there, when no one else believed that India had a consumer story worth venture capital, right? India always had a consumer story, right? You convinced your LPs back then to back that conviction ahead of the evidence itself, which would emerge only later. And you built Fireside against the grain of an industry that's famous for chasing where the current action is, and the action back then was tech. And that's what I want to understand today, the thinking and the person behind that.
Sure. Pleasure to be here. And like you said, 20 years is a long association. So looking forward to this.
All right. Give us a sense of Fireside Ventures. What is it?
Sure. So, see, fundamentally, let me actually talk about why even the idea of Fireside Ventures happened. And, then I can talk a little bit more about what we do. So, to me, the idea of looking at consumer and consumer brands and consumption as a thesis, in some sense, the genesis of that was really love for everything consumer from my early days at Hindustan Lever. So that was my first job, and you always get fascinated by what you see and what you learn. So having traversed from Hindustan Lever to Intel to Carlyle to Helion, somewhere, I kind of came back full circle to say, just as a, personal almost interest, or, call it first love, to explore what was happening in the consumer space. So to be honest, I actually tried doing some investments while I was at Helion. And I realized that two things were happening. One, there was some spark of something seminal, something changing at the foundation level was happening in the consumer space. And I'll talk about that. But also I realized that doing that exploration within a tech fund was never going to work, because the DNA of these businesses, the way you look at it, and like you said, it's not really anyone's cup of tea at that point of time to invest in the consumer space. So I took this, I would say very orthogonal call, but at a stage of my life when I felt like I had seen it all. So, the risk of taking a interesting decision in my early 50s was something that both my family, my wife and I felt, let's give it a shot and explore what could be in a very unknown kind of territory. And the positive, let's say, draw for that was a few interesting trends that were starting to emerge. One, like you said, India is a huge consumption market, but extremely, I would say, bereft of interesting new brands. And the key reason for that was that there was not enough ability to build businesses because the infrastructure was broken. You had to distribute to mom and pop stores. You had to advertise on, typically national or large, mass media kind of channels. So here you have a consumer who's looking for choices. India is a young economy. They are very exposed to global trends. And on the other side, infrastructure is not allowing new brands to get built because it's very complex to build a business where you have to go and distribute to mom and pop stores as a startup. But what was really happening at this time, let's say in the 10, 15 year ago time frame, 2010 to 2014, was that the digital infrastructure had started bringing in a very different paradigm of both talking to consumers through digital media, Meta, Google, Instagram, and distribution through channels like Amazon and Flipkart. Very early days, but you could see the spark. And therefore, my, big, hairy, bold idea was that can something be done here? So I left Helion in 2015 and I started investing my own money in this paradigm of young, new age startups leveraging the digital infrastructure. In fact, probably less known fact, I set up Fireside like a family office.
I have that question. I'll come back to that. How you went
Okay.
about first
Sure.
establishing that conviction at a personal level before you took it to an institutional level.
Sure.
Right? But for those of the people who don't understand, what is Fireside Ventures?
Okay. So Fireside Ventures, in the very nuts and bolts sense, is a early stage venture fund where we invest in companies which are building exciting new age brands. So in a sense, we are early stage, we back startups, we back exciting founders. The only difference from the more traditional, definition of venture where you will do tech investing is we invest in companies that are building exciting new brands. And typically these brands tend to be digital first because, like I said, this is the way the new age brands find their initial product market fit and consumer love. So we invest in a company, and the typical model is that we will come in very early. We have done investments even pre-revenue at a seed stage, but our sweet spot is there is some product and market, you have some evidence of consumer data, and you put in, let's say, a $1 to $2 million check. Companies are doing 8 to 10 crores or so in revenue. So that's our sweet spot. Then we actually have a very structured program, I'll talk about that, of helping these companies navigate the early journey of how do you establish product market fit. So how do you work with your channel partners? How do you think about brand? How do you think about new product development? How do you think about what kind of organizational strengths you need? How do you think about marketing? And once they hit, let's say, 30, 40, 50 crores of revenue, we double down with a larger check than the previous one. So as a reference, if our first check is, let's say, 10 crores, our second check could be 25 or 30 crores. And that is the runway the company needs to then go to the next level. So almost till 100 crore, 150 crore, we are underwriting their journey. Not just by 2, even sometimes 3 rounds of capital, but also a very structured way of how we can help them. So that is really the story of Fireside in terms of what we do. Then
Got
we
it.
help them raise money from external investors. Then the journey goes into either all the way to an IPO, which happened with Honasa, or it goes into some exits through strategic
Got it.
acquisitions.
Which is a great point for me to ask you. What to you might sound like a stupid question, but at the end of the day, Fireside Ventures is a company. How does a company make money?
Okay. So Fireside is basically, in a very simple sense, uh, what technically is called alternate investment fund, where we raise money from investors. Now, these investors could be families, individuals, institutions like banks, insurance companies, or even in the global sense, university endowments, sovereign funds, and all that. So it's a very wide pool of what is called limited partners who commit the money to a fund as a way for giving us the corpus. We then invest that money on behalf of these investors. And as the company builds out, as they grow, eventually we exit these companies because we take equity ownership in these companies. We exit these companies by way of selling our shares either to larger private equity players or to strategics, or like I said, sometimes even they go IPO. And the difference between what we put and what we get then becomes the overall success or
Got
profit.
it. Got it. Few quick questions to get some stats about Fireside. How old is the firm? How many people work there? And give us a sense of the revenue. Normally, this question that I ask when I ask founders, it's like, "What's your revenue?" Right? So, what are the stats which, with respect to Fireside, that give us a sense of that?
Sure. So we are 9 years old. We started in 2017. We have about 37, 38 employees. And a large part of that is all on the investment and the support teams that work with our companies. In terms of the revenue question, we define it as what we call AUM, which is assets under management. We have raised 4 funds, and together we have raised about 5,500 crores. We are investing from our 4th fund, which was the latest fund, which is about 6 months old. And that was approximately 2,300 crores in size.
Got it. And how many companies have you invested?
So we have 68 investments all the way from day one till today. I would say about 40, 45 would be active because some we have exited. So as you build the portfolio, you obviously keep moving on to the next fund and to the next fund.
Got
But
it.
overall, till date, about 68 investments.
All right, great. Now let me go back to when you started Fireside. Now, when you went out to raise your first fund, and it was for brands and consumer brands, what did the investors that you spoke to, because most of the times when I'm having this conversation, this is feeling very odd to me, because when I'm talking to founders, I'm asking them, when you went to investors, what did you tell them and what did they tell you? You're an investor yourself, but I think it's the same question is relevant for you, because you also have to go to your investors and try to convince them of your pitch and your story. What was your pitch when you originally went to your earliest LPs? What did you tell them? What they tell you?
Sure. So, I mean, just to clarify the first part. For a typical fundraise for a founder, you have to meet, 10, 15, 20 investors. To raise a fund, you meet 150, 200 investors. So it's the fundraising doesn't go away.
Why is that?
Yeah. So because, the amount of money you're raising, you're not raising from 1 or 2 investors. So typically
So it's
in a
not
fund,
like a founder where there is a lead investor, they
Yes.
commit,
Yes.
right? So you need a lot of people to chip in.
That's right. So typically, a fund may have, if it's a India-focused fund with a lot of Indian families and, individuals and some institution, you could have 50, 75, 100 investors.
Oh,
So
and obviously the number of
and
people
then
that you
the
have
hit
spoken
rate,
to
yes,
hit.
Absolutely.
Okay.
Absolutely. Okay.
Interesting.
So that was just a clarification that it is a complex fundraise. I think when I went out, honestly, Rohin, there were 2 convictions. One conviction came from the thesis itself, which I talked about, that there is something here which is very, very interesting from consumer infrastructure and the kind of startup entrepreneurs who are coming into this game, that there could be a new way or a disruptive way of building brands. which are addressing the new age consumer. And that time we used to talk millennials, today is Gen Z, but the consumer is, almost defining what their choices are. So I would go out and talk to investors, and I also realized that this is not a quote unquote thesis which would be appealing to global investors. So incidentally, we had raised all our money in Helion from only global investors. And I quickly realized that I had to flip the coin completely and start looking at India as a source of the money. So my basic focus was to talk to.
Sorry, I mean, why was that? Why wouldn't a global investor be interested in the consumer brand story?
So I think, first of all, it is a very unknown space at that point of time, for sure. Second, it is also a situation where you are raising a small fund and your ability to show what is the data in the past on success is very limited because there is no precedence. And for a global investor, you have to first convince them that India is exciting. Then you have to convince them that consumer is exciting. Then you have to convince them that an early stage, first time founder, single founder. So there are lots
there are
of
too many
check boxes
variables.
which you don't meet. So it was a very practical decision saying, although we had amazing investors in our Helion cohort, I felt that we would not be able to raise money from them. So therefore, the port of call was Indian investors, and within that, largely consumer families. And the reason for that was that when you go and talk to a consumer family, and again, I can name a few. I mean, I had a wonderful conversation with Harsh and Rishabh Mariwala at Marico Sharp Ventures, with Premji Invest, with Sunil Munjal, with Sanjeev Goenka. And all of them said that, we really like what you're saying. We don't know how it will shape up, but we are supporting you because we feel that there is a learning exercise for all of us. So it became a little bit of a marketing investment as much as investing behind a thesis. I think the only thing going for me was that I had spent 2 years after leaving Helion in creating a portfolio of my own investments.
Yeah, I mean, tell us about that.
So that it was very interesting. When I left Helion, I had no plans to raise a fund. So I decided that.
So it sort of decided to quit and quote unquote early retire, or like
No, not retire. I wanted to be a full-time, engaged player.
Investor.
But I thought that, my own ability to work with companies, I will put some money, I will work with them. So I would take both positions.
You would be like an angel investor.
I would
who's
be like
active.
an angel investor, but in an active sense, not on the side. So that's when I invested in companies like Licious, Mamaearth, Epigamia, Paperboat. These were all my personal investment. Yoga Bar. And that
pretty solid hit rate for an early angel investor.
There was a flip in my head that this was something which required institutionalizing because it was real, it was happening, and some of these companies, even in those early days, were starting to show signs of what could be. So that's what prompted the idea of a fund. And honestly, the name of Fireside came through one epiphany I had saying, there is always this founder side and investor side. There's a big divide in the middle and all kinds of, relationship questions we keep getting asked. So I said, listen, I am an individual. I want to be the best friend that a founder has ever had. I want to be on their side of the table. How do I express that? And then suddenly it struck me that Fireside is a very nice, it gives you a cozy, warm feeling. It's sitting around a fire, it's friends, it's mentor and partner kind of relationship. So that's how the idea of Fireside came about. And then when I started the fund, I thought, this was a very credible way to even create the idea of what Fireside as a fund could be. So I just translated that name to Fireside.
Sorry, just a quick question on this transition from being quote unquote an active angel investor to raising a fund. Now, you said that you had no idea that you'd start a fund when you quit Helion.
Yes.
So at some point when you'd invested in enough consumer brands as an individual angel investor, you realized that there is a larger story, opportunity, scale here. What was that trigger point?
So I think it was two interesting parallel points converging. One is that this was real. So the hypothesis of saying there is a consumer looking for choices, there is infrastructure which is coming, disruption is happening, was starting to show up.
So you're seeing that in the numbers
I was
or the
seeing it in the
traction
early
behind these.
traction and
Got it.
early, almost the models that were being developed. Interestingly, there was a flip side to that, which is that I also realized that this was such a new space. Nobody, neither the founders nor me, nor even the large companies knew how to deal with it. So therefore, a one man, going around trying to help companies didn't sound like the right way that we could create some kind of a, almost like a best playbook or a, best practice kind of a story here. So the idea of a fund was not just that this was real and it could become big. That was one part of it. But the second part, which was equally important, was that there was an opportunity to institutionalize what could then become a playbook format where you could help lots of companies because nobody really knew what the answers were. So can a fund take that initiative and solve for it? Second thing I realized, which we spoke about, is that there is no money to support these companies. So my small checks were never going to be enough. So therefore, you need some institutional capital to get at least the momentum going. And then as they grow, then you look for, different types of investors to come in. So there was need for money. There was need for support and very structured way of helping them. And the opportunity was starting to show itself. So all these 3 points converged to come with this conviction that a fund format was a better idea. Now, raising a fund is a different ballgame. So when I started talking to investors, the whole question was, is there enough data? Where is the track record? Nobody has done it before. I remember one very interesting conversation I had with somebody who introduced me to Harsh Mariwala. And he said, listen, Harsh is going to ask you this question, what is track record and all. So I just instinctively told him, I said, see, if I'm not driving this car looking at the rear view. I'm looking at the road ahead and I'm seeing a great opportunity. I have to convince him that this works. Now, whether he gets convinced or not, I can't say, but my attempt is not to say, oh, look back and see what happened in the past. And to their credit, Harsh and Rishabh were very supportive. They literally signed up as soon as, I met them. We had a long 90-minute conversation. So I think in some ways, it was a blessing that this cohort of investors who really understood the opportunity and they wanted to be a part of it. And some goodwill they saw in working with me as the person who will, develop this potential opportunity. So that's how the idea of Fireside really came about.
So it's interesting that you should mention Harsh Mariwala. He's been a guest on First Principles as well.
Lovely.
So it's great to have
he's
that
amazing.
connection.
Yeah, he's amazing.
When these families, the Premji Invest or the Mariwala family, Munjal family, etc., when they decided to become investors in your first fund, were they betting on you? Were they betting on the idea, or was it some mix of the both?
See, in a startup, you always bet on the person first. So I certainly believe there was some conviction that, I could be the person that they could get some, learnings from, or obviously return and higher capital appreciation as well. Also, there was this feeling that the goodwill in the market of having been there and, worked with some of these amazing founders, like I mentioned, Licious and Mamaearth and Yoga Bar, that there was some credibility that they associated with it. So I would say certainly the individual first, but the belief that there was disruption in the market, that this could become interesting, could only be understood by people who were in the business. So that was the big reason why a lot
That's
of the
why you said consumer families.
Absolutely.
When you said consumer families, the implication is that they are families that own and manage consumer brands.
And who have some presence themselves in the consumer space. So they appreciate what this could mean. Interestingly, the other investor who came on board into the first fund itself was Unilever. So Unilever had a venture arm and they said, we want to be a part of this journey. So, and in our second fund, L'Oreal came in. So, that's
So in some senses, everybody who's joining in has yes, they have a vested interest in returns, but more than that, they have a vested interest in essentially that this space grows and it explodes and there is more. So they're all aligned with you on this vision hopefully coming true, right? So they want that vision to come true.
So I think that, like I said, it was a blessing that we got people who were believers even before we could show the results. So, I mean, again, to add to names, ITC came in. And I remember, having conversations with some of the senior folks there, and everybody had this very intriguing, perspective, saying, this is, remember, 2015, 16, 17, that
Yes.
time frame, saying something is going to happen. We don't know what. And good news is that we are all in touch. They're all, part of the journey. We have conversations. We exchange ideas. So it's almost become like you said, it's become an ecosystem. And, then, as you know, ITC acquired Yoga Bar, and, we have had, very good relationships with most of our investors across the board. So in a way, it was a kernel or a seed of an ecosystem, which is, I think, a great positive for the industry and for all consumer, not just startups, but even for the larger brands, that this happened.
Got it. I want to switch tracks to the Fireside Ventures as a fund. Um, Based on my research, over time you've changed the size and ownership target
Yes.
of your funds from about 10% in Fund 1 to about 20% later.
Yes.
And just for clarification, what that typically means is when you invest into companies, like you said, you invest across multiple rounds. Would I be correct in saying that the ownership target is how much of a company do you want to own at a particular stage and scale? That's what this
That's
means,
right. That's
right?
right.
What was the assumption when you thought 10% would be enough, and what was the reasoning behind no, it needed to be 20%?
Sure. So the idea of 10% came from the fact that we raised a relatively small fund. So that was, again, by design. I felt that raising a very large fund without even proving that this new hypothesis, it works, how does it work? So I set out to raise a 350 crore fund. We raised 350 crores. Now, obviously, when you have a fund of that size, you are also looking at the check size, which is commensurate with that. So we felt that, we could do 4-5 crores of investing, come in early. And that meant that companies would be valued in the 30 to 50 crore type of a valuation. So 10% became the default. So it wasn't a design that we wanted 10%. It was more size of fund and what check size we could write.
It was constraints and assumptions earlier.
Yeah, so I guess it was also trying to prove that, we didn't want to, do only 5 investments with large checks and large ownership, because we didn't know how it will shape up, and there was a learning curve involved. By the time we reached our second fund, which was our 860 crores fund, we realized that there was 2 interesting learnings for us. One is that there was some method to this whole, early stage investing in our space starting to emerge in our heads. We understood, how you build digital first brands. We understood D2C. We understood marketing, performance marketing, and therefore we could help. Now we also felt that because we would bring in this value and because we were seeing that this was a real space, we raised a larger fund. But second, we also felt that we needed to have a minimum ownership because of all the work we were doing and, the way we were building out, both in terms of our team, our playbooks, our way of working with them, that we needed to have a certain minimum ownership to justify all that effort. Because then obviously you are backing yourself that I can put more money in a company and I can get a better return. Also, we realized that, like I said earlier, our model was write a smaller check first and then double down. But even in the doubling down, it's very difficult to increase your ownership after a point of time, because you are typically doing what we call pro rata, which is that if I own 20%, then in the next round I can take 20%
maintain
of that
20%.
to maintain my ownership. So if I start with 10, I am stuck at 10. So therefore, starting with a higher number and being able to maintain that over next 2 rounds, 3 rounds was very important. So 20% was more by design, 10% was more by early learning and constraints, as you called it.
Got it. So that 20% means you'll try to come into a company's cap
And
table
take
at 20%,
yes.
and then hopefully stay there, unless of course there are exceptions where you have the opportunity to increase it,
Yes.
etc. and
Yes,
stuff like
absolutely.
that. Very interesting. Now, most people aren't aware of how venture capital funds operate because they typically read about them in the newspaper saying that this venture capital firm invested, so they think that it's just investment. But would I be right in, in saying that typically for you, only about a third of the fund of a fund goes as the first check into a company, and the remaining two-thirds of a fund is kept back for additional investments. Is
Uh,
that broadly
uh,
right, or am I?
no, just the terminology I'll correct.
Yeah.
You're right. We typically look at about 35% as the what we call portfolio construction, which means that the first check
Hmm.
in X number of companies goes in to make our portfolio for each fund. The balance two-thirds goes into the same companies as a follow-on.
Yeah.
So it's a follow-on. It's not additional companies that we
No,
invest
no,
in.
yeah, yeah. My bad
I'm
if
just
that came
clarifying
across
that.
like that. Yeah.
Yeah,
So the third goes as first checks, and the rest is
is
second
follow-on.
checks or third checks,
Yes,
etc., and stuff
absolutely.
like that, right? Uh, how do you? I mean, what does this? Because when you're writing the first checks, you really have no way of knowing which ones you will double down on with the second checks and third checks, etc., and stuff like that. Is there a method to how this evolves over time, or do you just look at traction and go like, over four funds, what have you learned about
Sure.
this sort of follow-on investment?
Sure. Actually, I think this is a very unique formula which has really worked well for us. So there are some, I would say, very distinct characteristics of what we do versus the tech industry. And again, this is our model, and the tech world is a different model. In our world, what happens is that this first check is a relatively small check. So, to give you an example, my last fund is about 2,300 crores. I am still writing the first check of 10 crores, maximum 15 crores. So I have not changed my strategy to say, oh, I have a larger fund. Now I will write a 25, 30 crore first check. And I'm still taking 20% for that. So my stage of investing and what I do has not changed. Obviously, over 8-9 years, not just me, but I have built a team. We have all got better judgment. We understand market better. All the learnings from doing deals or not doing deals has got baked in. So hopefully, our hit rate and our success rate keeps improving. The real magic happens is that because we work closely with the company, and again, we have this concept of center of excellence, and I'll talk about that. We are able to get a very good sense of how the company is shaping up even as early as 6 to 9 months down the line. So my second check is calibrated not as a like one shoe fit all across the portfolio, is which company is breaking out, is now looking like they have established product market fit. Very often we can go and preempt the next round, saying we will only do the next check, we don't need to raise external money. So I am consolidating or concentrating my capital into these early winner visibilities. I'm not abandoning the rest. I will also put in my pro rata or some share in their company. But there I am saying I also need some external validation that there are other investors willing to come in, because that PMF is not yet fully established. So you can start seeing that I will start creating some level of concentration in what could be potential winners. As these companies grow, I have some capacity. So to break it up, the first check is 35, second check maybe 40, 45. We still have another 20% for a third check, which will go only to those companies which have broken out. So by that time, you have very high visibility that these
So the
companies are doing
cohort
well.
keeps reducing. You take the net is cast widest with the first check.
Yes, so it's a
Then
classic, you are concentrating more and more capital. And the good news is that that visibility can happen very quickly. So in our business, if you can say that I have, I'll give you actual numbers. We have seen 60+% success of portfolio in fund one. Fund two, that number has jumped up to 80+%. And fund three is still relatively young, but we expect a similar 80-85% success.
when you say success, what is your definition of success?
Success, very simplistically, is companies which return capital plus some additional.
There's some
So,
positive return.
Yeah, so they are not, either write-offs or they are companies which won't make it. So that is a very different thesis than what you would call a power law.
Yeah.
And that is what has really been our biggest mantra, that we can build successful funds, fund after fund, by creating portfolios which are successful as a very high percentage of success and not necessarily depending on those one or two outliers. Good news is we also have the outliers. So, it's a compounding combination of outliers plus, a very large percentage of companies giving us returns more than capital plus plus.
Got it. This is worth understanding. And just for context, the power law simplified in the context of venture capital investing or tech investing is like typically a handful of companies, couple of one or two companies will return the entire fund
Yes.
and more, right?
Yes.
And it'll be whatever, a 20x, 50x or whatever, right? Then a handful of others or like some others will give you decent, and there'll be a lot of failures.
Yes.
And that's okay because the ones that break out and succeed will more than enough compensate, right? Now, you're saying you're able to distribute it in a broader way so that, yes, there are hits, but it's not that the rest can be ignored, most of them. So, I mean, if this were easy to do, why wouldn't anyone do it? Like, wouldn't every fund want to say, I mean, I'll also try to do 60%, 70%, 80%. What is it that you're doing? You seem to have hinted at that because you said that we are doing something differently
Sure.
from tech
Sure.
investment funds. What are you doing that allows you to do this?
So I think there are two fundamental reasons why. One is it's a philosophical point. I think conventionally the attraction and the ability to deliver a 50x or a 100x has always been very attractive because that's what defines not only fund success but individual success. People say, "Oh, I invested in this company and it went 100x." So
Right. Legendary investor in
yes,
Google, legendary
yeah.
investor
I
in
mean, for a
Facebook.
5x,
Or,
nobody
yeah,
will call
correct.
you legendary, right?
Right.
So anyway, that keeping aside, I think the second most important thing is that this requires a very different way of how you build the entire infrastructure internally as a fund and how you work with the companies. So to give you an example, I have this center of excellence team which is larger in number of people than my investing team at the same level of seniority. So what that really means is that we are.
What do they do? What is the center
So
of
I have
excellence?
a go-to-market guy, I have a marketing person, I have a corporate development, I have ESG, I have finance, I have HR. They actually actively work with these companies in helping them navigate the journey of building a brand and building a business. And not just that we can work with 70 companies, we have our ecosystem of partners, but again, somebody is shepherding that ecosystem. Similarly, companies who are getting started at a very early stage, we create these things called playbooks where we tell them, how do you work with an Amazon? How do you work in a D2C? Today, quick commerce has become exciting. Now, quick commerce is a completely new way of doing things. So how do our companies who are coming into the fold understand, how do I get started? What is my first job? How do I, engage? What is my strategy with Instamart versus Zepto versus Blinkit is all very complex. Excuse me. So I think that gives you then the ability to say, I can underwrite my own success because with all of this, I am able to see that more companies get into that success territory. And second is, like I said, I'm concentrating capital always in what I am myself and identifying as potential winners. So I think this very hands-on, high-touch, working with founders mindset again is a very different model to a typical venture capital model where you are betting on trends, and then of course good entrepreneurs who could be riding that trend, but you are taking those very futuristic bets like today AI, and again we see a lot of money going into AI. It's taking that futuristic point of view, saying looks interesting, it should work. If it works, it's a 50x 100x, but there is a high probability it may not also work. So I think our space is very different, and you're right, a lot of people can do it, and as you might be noticing, a lot of new funds are coming into the space. So we've always had DSG, we had Sauce, we had Six Sense, we had Fireside. Now a lot more smaller funds have come in. So there is natural attraction to what we believe we have been able to demonstrate successfully. But still, I would never expect that more than a small percentage of money will go into consumer because bulk of the money will always go into tech and tech-enabled
Got
trends.
it. When you do this, when you're more hands-on than, let's say, a tech VC fund, what is the trade-off that you make? Because if there is no trade-off, then what prevents every fund from saying, look, we'll all be hands-on? And frankly, a lot of funds do say that. Literally every VC fund almost says that we are the best friends to investors. We are always, or to the investee companies and to founders. We are on their side. We will help them. Yet it is also true that by and large, most VC funds are sort of hands-off.
Yeah.
And you're saying that you are much more hands-on. And from what you're saying, it looks like it's hard work.
It is.
So there must be some trade-off that you're making which is preventing others from just defaulting to this, because money is clearly not that much of a constraint for most VC funds because they do have money. So why doesn't everyone do it?
The answer lies in the question. It is hard. And it is a belief that this is one way of doing it. So therefore,
which is why you said philosophy.
So I'm saying that, I believe that this is the right way to do it. How do you, handhold the founder? How do you provide value without taking over the business and saying, I will run it for you? That is not the intent. So therefore, yes, anybody can do it. But it is genuinely convincing yourself that it is worth that effort. There is a cost involved. Like I mentioned, I have 6 or 7 people. These are people with 15, 20 years of experience. So I am investing my own, capital or my own whatever resource in building a team like that. Then it is also trying to create this, internal environment and philosophy or culture,
which is all an overhead. I mean, from a traditional VC's point of view.
Like you said, the legendaries are all individual glories. Here we are trying to create a system where, our deal team is working with our COE team. We'll have multiple people touching the company, so we have to make sure that, there is no sense of proprietariness. So this is my deal and this is your deal. So it is culturally a very complex, I would say, deviation from the typical model of investing.
Has it been easier for you to do it? Because in many ways, you started this as a single founder. Unlike most of the VC funds, either which are like in some senses, whatever, 100-year-old VC fund from the US or somewhere else that has decided to start in India, therefore, or a bunch of people come together and decide to start something. And down the road, initially they have some kind of cohesive vision. But over the years, of course, there are prima donnas and everyone has their own vision. So has it been easier for you because you had that conviction, you had that belief, and therefore you were able to kind of instill it? I mean, I'm seeing this in a company also. Typically, it's easier when there is a founder with a strong vision, right? Is that the same for you?
I think certainly the conviction is the foundation for this. The belief that I am doing this because I have a certain way of thinking, a way of visualizing what Fireside can be. And the very strong belief that this is not necessarily good to do. This is probably a better way to do. Again, that's my conviction. So that we can not just deliver superior returns, we can also create a legacy of something which can then sustain beyond an individual. So there is a very strong, I would say, underpinning here, which comes from the founder mindset. I think I'm blessed with the fact that I have some extremely good partners. So people who joined me in this journey, and again, Rohin, the funny thing was none of my partners came from investing background. So that was another big leap of faith. I said, whatever I have done in my own experience, I have some knowledge of investing, but I want people who come with operating mindsets, people who come in thinking, I want to help the founder. I am behind the founder to build success. I am not a financial investor who, is looking at spreadsheets and deciding what is the best course of action. Now, this is again a philosophical thing. So Vinay joined me, Kanan joined me, Dipanjan joined me, most of them. And now others has joined us recently. None of them come.
Others has been on one of our podcasts as well.
Okay. So again, you can see that the commonality here is a belief in a space. And therefore, we are very rigid about saying we will always be consumer first. We are not looking at, getting distracted with any other space. Again, no right or wrong. I mean, this is just our belief. And that was a hard road to go because investors very often, especially global investors, don't like single sector or single thesis funds. So they want to be more wider. They want to know because you're saying the next trend may be something else. Why should I miss out on that? So we stuck to our guns. We said we will do this, and we will design our LP base based on who believes in us, rather than saying we will design our strategy based on what the LPs want. Getting a team which is very oriented towards building businesses, helping founders succeed. And then what we did, another thing which was quite unique, is we made our compensation policies which were less hero worship. So we don't reward, I mean, we do performance management, but we don't reward extraordinarily a person whose one company broke the norm and became the biggest winner.
Got it.
We share it equally with the team, so that the next company which breaks out, then everybody gets the benefit. So a lot of these things start creating this culture of, what we call one fireside. How do you integrate everybody to work together? Because the underlying principle here is that we need multiple hands to help that company succeed. And it cannot be that we create these silos where, there's one person who's the only, connect with the company.
Got it. So that's the third thing which you did differently. The first thing that you did differently is you were a tech venture investor. You decided to go to consumer. Your LPs were largely international ones, and you decided to go with Indian LPs and Indian LPs who understood the space. And the third thing that you did was you sort of decided to build it almost like an anti-VC thesis around no prima donnas, no heroes. Let's all work in it together. That's interesting. All right. You're a consumer person, right? Actually, and yes, you did, kind of catch the consumer wave early. But after that, now there's been so many waves, so many explosions, and so many terminologies that have come in. Tell us about, do you have any thoughts on this entire India 1, India 2, and India 3 as consumers, sectors and spaces? And walk us through the map and how do you see these evolving?
So maybe I can expand the scope of the question a little bit. So we see almost 4 different vectors on how the opportunity is growing. So if you look at consumption, first of all, the macro number is very attractive. From 3.5, 4 trillion going to 5, 6 trillion, whatever that, it is still a large number in the next 5, 7 years.
Sorry, what's that number?
I'm saying the overall GDP.
Oh, got it.
Now, if you are saying that the GDP is going to grow by $2 trillion in the next 5, 7 years, 65% of that is consumption. So you are talking of a real $1.5 trillion. It may take 5 years or 7 years. How will that $1.5 trillion come? Now, if you break it down into these 4 vectors, so first of all, we talk about the consumers themselves. Now, our evolution in the fund last 10 years has been that from very much being very quote-unquote millennial focus, because that was the core of who we were targeting. Now we are seeing multiple cohorts appearing. So there is millennials, there is Gen Z, now Gen Alpha has started coming up, there's the seniors, there is a woman cohort, again, various different businesses which can be addressed to women. There is a young child cohort, lots of business models which address today's, kids, teenagers. So the complexity or the opportunity is becoming far interesting in the opportunity on, say, this first vector, which is consumer segmentation. Then you take the second segmentation, which is sectors. When we started, even when I started my own personal journey, it was largely FMCG, I would say largely food. So Licious, Yoga Bar, Epigamia, Vadam Teas, all these were my early investment. ID Fresh, which I did from Helion. But then we realized that out of FMCG, the other area that consumers are starting to spend more discretionary power, etc., is home, lifestyle, fashion. So both happened in the early days. Now we have several fashion companies. We have now invested in, I think, 3 or 4 home kitchen appliance companies. So you can see that the sectoral cohort increase. Then we also realize, especially post-COVID, that people are getting extremely conscious, not just about wellness, but also health. So we said that is also consumption. So we have now active portfolio of companies focused on health and wellness. So nutraceuticals, supplement, diagnostic devices. We have a mental health service company as well, Amaha. So that was the second thing, saying how does the sectoral cut come on top of this. The third cut was the channel cut. And the channel cut was digital first meant e-commerce, which is Amazon, Flipkart, Big Basket. Then we got into D2C, your own website, Shopify. Now it's quick commerce. And most companies at some point have to start thinking offline. So omni-channel, FMCG goes into distribution, non-FMCG goes into own stores, EBOs, etc. So there is that whole opportunity. Now you can say it's complex. So the good news is that it also makes it more interesting because you can build many businesses across many sectors, across many cohorts. And the last one is the geographic breakup. What we found is that India One was always the first adopter. So urban millennials in FMCG and lifestyle was, Fireside One thesis. Now it's evolving. But India too is equally aspirational, has equal access, has equal ability to buy products. And
How does India 1, 2, 3, 4?
so
split?
broadly, it is a combination of socio and demographic. So we basically, if you want to make it very simplistic, you can say tier one, urban, metro would be India one. But within that, you can argue that there are people who are gig workers, etc., who may be more socio-economically aligned to the India two kind of a mindset. But there could be a geographic way of splitting it and the socio-economic way of splitting it. But the aspiration part, the access part, even in, let's say, tier 2, 3, 4 cities, is now becoming very similar to India 1. The big difference is that you have to design for them. They are value conscious, they are price conscious. So if you say, I will take something that is available in India 1 and just transport it to India 2, chances are that it either won't work or work very limited way. So now we are talking to companies and we are seeing that success. Of course, Boat did it 10 years ago where they said, I have this product which is very well priced, but it delivers all the performance requirements that that particular consumer is looking for. So 60-70% of business used to come from small town of India, and Boat became like a status symbol, and it was not a Bose, not a Sennheiser, but a Boat. Now we are seeing companies like Pilgrim, for example. We have some companies who are launching for these consumers. So that is the second story. The most interesting thing, which we are in the early days of learning from, is India 3, which is rural India. So we have a company called Rosanna. And this is a rural distribution company which is actually targeting villagers in Gram Panchayat level village context. These are not even cities. These are like genuinely villages. But they have a very unique model. They appoint a local partner. They are typically a woman. I think they have 35,000 women who are partners in East UP and Haryana. And they then provide them with a whole range of products from staples, grocery, fashion, cosmetics, etc., but delivered to their doorstep through this partner. So imagine there is no marketing because there is no customer acquisition. The last mile delivery is done by this person, and the cash collection happens physically rather than through couriers and all that. So the cost of doing this business is very different structurally than, say, a Flipkart or an Amazon. And anyway, Flipkart, Amazon can't reach these villages because there's no address. So they are literally saying, behind the village, around the tree, kind of a thing. So now that is access. So if you look at the opportunity, you're solving for different requirements, but interestingly, aspirations and desire to consume is the same. So we believe that there is a massive headroom to be able to build very exciting new businesses in India for the next 10, 20 years. So still no dearth of opportunity.
Got it. From India 3 and rural distribution to quick commerce. Now you said that quick commerce is brand first rather than product first, and that most searches there are for specific brands. How does it change how young and new brands should be built? And does it worry you that this channel keeps getting more expensive?
So let me answer the first one. I think the power of the brand is truly manifest in quick commerce because for two reasons. One is the channel itself has constraints of space because they are promising a 10-minute or a 20-minute delivery. They are talking about very tight dark store strategy. So to
And the
get
number of SKUs that are kept in those dark stores have to be limited.
correct. So therefore, if you don't have the consumer pull, consumer is not going to ask for you. And if the consumer is not going to ask for you, the channel is not going to keep you. So that is the first, universal truth. Second is also consumer behavior. You are not, as a consumer, you are not going to a quick commerce channel to discover. You are going for a purchase. So in a way, it's a very close surrogate to a local kirana store.
I was just about to say that, because in a kirana also,
Correct.
they're very efficient at figuring out what moves.
Absolutely.
And if it doesn't move, they won't keep it.
Exactly. So almost the same analogy is you are going into a quick commerce store, whichever which you take, by looking for, I want either a particular product or very often 60-70% of the time by brand. So if baker's dozen sourdough bread is what I want, I would most likely type baker dozen sourdough bread because I know what I want. I just need to go in quickly, go out, because if I want a 10-minute delivery, I don't want to spend 5 minutes first discovering what to buy and then get a 10-minute delivery. So all our behavior, if we think back, is based on that. So therefore, the power of the brand becomes very important to be able to get onto this. So therefore, what does that mean? That means that how our companies are visualizing their money spent on brand building, how they are spending money on performance versus brand, what are the channels of doing that? All of that needs to be examined if you are in a quick commerce category. So again, that is an interesting discovery, right? Mostly food and beverage companies, small ticket size products will be very quick commerce friendly because they are immediate, they are impulse, they are repeat. Customers want to buy them regularly. But if you have luggage or if you have cosmetics or if you have some like health and wellness products, yes, you will love to have them on quick commerce, but it's not like my life changes because I can't buy it in 10 minutes. So again, there is a whole understanding, which is where our understanding of how quick commerce working, which particular each of these partners has different thoughts about how they want to build out. So we need to understand them. So I have people in my team who will go and spend like significant amount of time with the category heads, with even the founders of all these companies. And the advantage for us, Rohin, is that when we go to them, we are not going to say we have a company which does 5 crores. We say our 60 companies are doing 100 crores. So they also have a opportunity to work with us as a cohort and not just an individual thing. Second question is expensive. Yes, I think this is a serious question and we need to answer for that. But to me, the answer is still the same. If you have a strong brand pull, your ability to negotiate is much better. So if I go as an unknown brand to a quick commerce player and say, please put me on that, first of all, why should they? Even if they do, they will ask me for a high margin. They will ask me for a high marketing dollars because they will say you'll need to build your brand and you'll have to push for it. So it's a chicken and egg, which is solved in both cases by stronger brand building, which eventually...
What does that mean when you say stronger brand building? Because you said how you split your marketing between performance and brand.
Yes.
Like, are there examples from the last 1 or 2 years of how that shift is happening?
Absolutely. So see, the idea of, positioning yourself through storytelling, through creating the desire for the brand, through, building that consumer love, consumer connect is happening typically on the digital platform through media like Instagram, through YouTube. Facebook, Meta still continues to be more performance. So today, if I say I need consumers to come and click on an ad which says, this is my product, this is the price, buy me now, that is performance marketing typically. But today, if you look at, let's say, some very interesting examples, we have this company called Underneat. Now, they were launching a range of products in the shapewear category. Very small category. So you can argue small, we are saying opportunity, somebody can say, not enough scale in the market. But globally, skims and spandex and all are huge. The interesting thing was they were adapting it for Indian conditions, and they had one of the co-founders is a fairly famous Instagram personality called Kusha Kapila. So they were able to leverage the voice of Kusha as the person who could then talk to millions of consumers about the product, about the story, about why it's important, how it works, etc., which truly built the brand narrative rather than saying I am 50 rupees cheaper than the market, because this is not even a category which exists. So what do you bring in as an attraction? That company has grown from 0 to 100 crores in 9 months. I think in our experience of last 8 years, the fastest to 100 crores ever. And it was completely brand first. So similarly, let's take Truvi. Truvi is a company which is doing healthy, nutritious snacks for children. So no nasties, but also fortified with protein, etc. They took a very interesting route. They have a 9-year-old son, the husband-wife team. So they have genuinely, and not just a gimmick, called him as a co-founder. Because he's the one who's guiding their thought process on saying what products to launch, is it healthy for my child before I give it to anybody else? He is their chief taster, so he will actually taste the product and all that. Now, these are stories which you tell. And that is what brings affinity to the consumer, saying, listen, I buy into this kind of not just the fact that it's a great product, which it has to be, because that is table stakes. Without good product, you can't get any business. But beyond that, the connect with the consumer is working through the brand route.
If you've been a long-time listener to this podcast and are glad we're back, do tell the world by sharing this episode with everyone you think will find it valuable. This is me, Rohin Dharmakumar, signing off. We'll be back soon with another episode.